Loan explained. A loan is a quantity of money borrowed from a bank or other financial institution by one or more persons or businesses to finance scheduled or unanticipated occurrences. The borrower thereby incurs a debt, which he must repay with interest and within a specified time frame. Before any money crosses hands, the beneficiary and the lender must agree on the terms of the loan. In some situations, the lender will compel the borrower to put up an asset as collateral, as specified in the loan agreement. Individuals, corporations, and governments can all receive loans. The main purpose of taking one out is to obtain dollars in order to increase one's overall money supply. For the lender, interest and fees are sources of income. Types of loans. There are three categories of loans: open-end and closed-end, secured and unsecured. Traditional loans, closed-end and open-end. The term closed-end or open-end refers to the type of loan. An individual who takes out an open-ended loan has the option to borrow again and again. Although both credit cards and lines of credit have credit restrictions, they are excellent instances of open-ended loans. A credit limit is the maximum amount of money that can be borrowed at any given time. Individuals may opt to spend all or part of their credit limit, depending on their financial needs. Every time one of these folks uses his credit card to purchase something, the amount of credit available to him reduces. Individuals who take out closed-end loans are unable to borrow again until they have paid them off. The loan balance reduces as repayments are made on the closed-end loan. If the borrower needs more money, he must apply for another loan from the beginning. The procedure comprises submitting documentation to demonstrate creditworthiness and waiting for approval. Auto loans, mortgages, and student loans are examples of closed-end loans. Loans, secured and unsecured. A secured loan is one that has some type of collateral backing it up. Most financial institutions, for example, require borrowers to submit their title deeds or other documentation proving ownership of an item until the loans are fully repaid. Stocks, bonds, and personal property are examples of other assets that can be used as collateral. When people need to borrow substantial sums of money, they usually ask for secured loans. Because lenders are hesitant to grant huge sums of money without security, the recipient's assets are held as a type of assurance. Lower interest rates, rigorous borrowing limitations, and long repayment periods are all prevalent features of secured loans. Boat loans, mortgages, and auto loans are examples of secured loans. An unsecured loan, on the other hand, does not require the borrower to put up any assets as security. When it comes to unsecured loans, lenders are extremely rigorous in evaluating the borrower's financial situation. They will be able to determine the recipient's repayment potential and decide whether or not to grant the loan. Personal loans, credit card purchases, and student loans are examples of unsecured loans. Loans that are traditional. When applying for a mortgage, the term is frequently used. It's a loan that isn't guaranteed by the government, such as the Rural Housing Service. Consider these factors before applying for a loan. If you're thinking about applying for a loan, there are three things you should check into first. Obligations for the month. A loan applicant must also consider their monthly obligations in addition to their income. For example, a person may earn $7,000 per month but owe $6,500 in monthly responsibilities. Lenders may be hesitant to lend to such individuals. It's for this reason that most lenders want applicants to detail all of their monthly expenses, including rent and utility bills. Income. Another factor to consider before applying for any type of loan is an individual's income. An employee must provide their company with a salary letter, pay stubs, and W-2 forms. If the candidate is self-employed, however, all he needs to provide is his tax return from the previous 2 years and, if relevant, invoices. Score and history of credit. If a person has a solid credit score and history, it demonstrates to the lender that he can make timely payments. As a result, the higher the credit score, the more likely the person would be authorized for a loan. An individual with an excellent credit score also has a better chance of obtaining favorable conditions. In the last, a loan is a sum of money borrowed from a lender by an individual or a business. There are three types of loans: open-end and closed-end, secured and unsecured, and conventional loans. However, regardless of the type of loan sought, the following 3 factors should be considered before applying for a loan: monthly income, expenses, and credit history. The benefits and drawbacks of bank loans. Bank loans can be used to finance inventory and equipment purchases, as well as operating capital and money for business expansion. These loans are a tried and true way to fund a small business, but banks often only lend to companies with sufficient collateral and a long track record, and the terms they give are generally very severe. Business owners should assess the benefits and drawbacks of bank loans versus other financing options. Benefits. Interest is tax deductible. Business bank loans have interest that is tax deductible. Furthermore, loan servicing payments stay consistent throughout the life of the loan, particularly with fixed-rate loans where the interest rate does not alter. This makes budgeting and planning for monthly loan installments more easier for firms. Even if the loan is an adjustable rate loan, business owners can calculate future payments using a simple spreadsheet in the event of a rate change. Keep the company under your control. A bank lends money to a company based on the company's valuation and its capacity to service the loan by making timely and complete payments. Unlike equity financing, in which the company issues shares, banks do not own any of the companies they finance. Bank employees also do not participate in any aspect of the operation of a business to which they have given a loan. This implies you have complete control and administration of your company with no outside intervention. A bank loan is only temporary. Once a company borrower has paid off a loan, the bank lender has no further obligations or engagement with the borrower unless the borrower decides to take out another loan. Through contrast, in equity financing, the corporation may pay dividends to stockholders for as long as the company exists. Drawbacks. Business fails and is unable to repay all. One of the most significant drawbacks of bank loans is that they are extremely difficult to secure unless a small business has a long track record or expensive collateral, such as real estate. Banks are careful to lend only to companies that can clearly repay their debts, as well as ensure that they can cover losses in the event of failure. Personal guarantees may be required of business borrowers, meaning the borrower's personal assets may be taken if the firm fails and is unable to repay all or part of the loan. Interest rates that are too high. Bank small enterprise loans have high interest rates, and the amount of bank capital that a business qualifies for is typically insufficient to cover all of its demands. Because the business must not only service the loan but also deal with extra funding to cover funds not provided by the bank, the high interest rate for the funding it does obtain often stifles its expansion. Hope you understand what is loan, benefits or drawbacks, and what are the requirements while applying the bank loans. Have a nice day.